Good day, fellow investors. We just got out of the virus situations for the last 2 years, and now that virus decides to invade. When will life finally get back to normal? Or what's awaiting us? Let's discuss. We have had a great 2021, and now we have the Russian situation really hitting on a lot of developments that were already priced in the market. We'll discuss the situation also in Russia. We'll discuss the economic situation, the yield curve starting to go for inversion, and what does that mean? The Fed's possible ability or inability to counter with new measures to push the economy growing higher and higher, why it could lead to a recession, and then what to do as an investor. So let's immediately start with the great 2021 that we have had. Of course, we had the big fall of economies during the start of 2020, but then, especially if you look at from the bottom, all things have recovered well, and the forecast has been that it will keep on recovering in 2021. But some countries like Spain are still pretty below the pre-pandemic trend. Others are already okay, like the US. And if you look at the current situation, especially at the end of 2021, the global manufacturing index is extremely green, which means all things are looking well, everything is going good, really a lot of demand, a lot of production, everything good. As you can see, before the pandemic, things weren't that great already, then really bad, and now really great. But the question is this sustainable with higher inflation? Because inflation now is globally 4.5%, and you can see how really across the globe inflation, even 6.8% in the United States, has been really going higher and higher. Now, the expectation is that this inflation is transitory and that it will subdue and return to normal levels, but given the current situation in Russia, it is not certain it will happen. Because all these estimates were before Putin decided to do what he did, which is a sad situation for the whole world, because I sincerely thought, I knew it could happen, but I sincerely thought that we were past this kind of human, if we can call it human, expressions. I thought that thanks to communication, thanks to technology, that we will not see wars anymore, because in a war there is no winner. All the parts involved are losers, and especially those directly involved in the war. So Russia will be the big loser, there is already the big loser, sanctions are starting, the market's destroyed, the assets will be likely frozen, and depends on how long will this last. On investing in Russia, there is a war going on, so all the fundamentals, anything that has rationality has disappeared. There is nothing more of that, it's just a bet on something, just extreme speculation now on what can happen. Maybe they will replace Putin and go back to normal. You never know what will happen. I hope just that the situation solves for all the civilians involved, because it's a really great shame what's going on. But we have seen, okay, oil going up, then settling a little bit down, but we'll see whether it will continue to go up. And this already has a big impact on prices, on inflation not retreating as it was expected. We already have seen the euro weakening after the attacks, so that is already 1-2% hit on consumption from Europeans in relation to US dollars. Now let's see a little bit deeper how this can impact the economic fundamentals that are there. So the lowest global government debt to GDP has been with Russia, and one would think that this is because of fiscal smartness, but at the end it seems it is because we want to invade other countries and we can't rely on foreign financing. So really crazy, but that's the reason for this. But irrelevant now, they have signed their own destiny. China is a little bit better from a government perspective, more corporate debt there. But if we look at Europe, US, government debt ratios are really skewed to the highest historical levels, which means that when you have a lot of debt, you are really in a difficult position for making new decisions. You can't have debt. Okay, you can because Japan can, but it's not really that easy to maneuver and to make decisions the more debt you have. And this is also a risk for the global economies, because at some point it is logical that this expansion of debt is not sustainable. When will that come? Nobody knows, but at some point it will not be sustainable and something will have to be sacrificed, likely currencies. And then if we look at market expectations for policy rates, we are still below zero for a few years in the Eurozone, Switzerland, Japan. Okay, the UK already started pushing higher, the US is expected to start pushing higher, but these are still very, very low interest rates of 0, 1, nothing in relation to historical levels. Also, central bank balance sheets are expected to stay stable, so keep on growing if they need to do more intervention because of the current situation. Global trade, Russia is trading with the whole world, so it is well diversified and nobody is really trading just with Russia, so that's a positive for the world, but it will still have an impact. However, with impacts on supply chains, especially on commodities, we already see the World Container Index going up 4 times, so this might stay there for longer and then hit again inflation, push inflation higher, and force the Fed to push rates higher even when the economy, because of inflation, might be slowing down. That's the key issue there. And with inflation higher, if we look at the contribution to US real GDP, you can see that consumption is key, higher inflation, lower consumption, and then that might lead to a recession. Fortunately, there is still excess household savings from the pandemic that can still push the economy higher a little bit, but you never know for how long. And then when you look at things, there is another indicator that says, okay, this has to be watched, the yield curve inversion. If we take a look at the yield curve, which is the 10-year treasury rate minus the 2-year treasury rate, where it's logical that the longer date treasuries have a higher rate because it's higher risk. And the thing is that when investors want to lock in higher rates for longer, expecting lower rates in the shorter term, then it says that investors expect a recession. So whenever this yield inverts, you have a recession. Inverting, recession, inverting, recession, inverting, and then I think the pandemic stopped the recession because we have seen the manufacturing index being in the red a little bit, and now we have had a small recession of a quarter, but now again you can see these yield curves going for inversion and going lower, so it might invert, expecting that the Fed will not be able to raise interest rates, which is then again a very, very interesting situation. And this is the key. Okay, recession, okay, Fed, ECB intervene, print money, lower rates, and then we go again to growth. Governments take more debt, but that cycle has been used over the last 10 recessions. What if they can't do that? We can see inflation. If there is inflation, the Fed will have to forcefully increase rates to stop inflation no matter what the economy does. So those are the forces that start coming in and really changing the situation for all of us. And maybe not the Fed, but especially the European Central Bank will have its hands tied. So close to Russia, so depending on the commodities there, so related then to inflation, and expectations are for, yes, higher rates over time, but it might be absolutely not possible, A, slow down the economy, B, maybe forced with economies slowing down. So this is the expectations on economies doing good, and that's something we'll have to see, so one has to expect anything. The ECB balance sheet has also exploded and will likely continue to do so given the situation, which means more inflation, currency issues, etc. Now, on what to do I really think that Seth Klarman nailed it in his letter. The link for the video will be in the description below. Be prepared for adversity. You never know when it can come, and we are seeing it now. Avoid leverage in the stock market. This is one that really is special to Klarman. Limit portfolio duration by holding investments with catalysts. That might also be a dividend, so something that you like from an investing perspective, something that gives you value in the relatively shorter term. Focus on the downside, what can go wrong before investing, and actively manage a book of hedges. So we'll see whether a recession will come in 2022 or not. I think we have to be prepared for it, and as Klarman says, how to invest and to be prepared is to really look at the downside, look at catalysts, look at value, and really strengthen your portfolio from that perspective. Thanks for watching. I'll see you in the next video.